Last week, both the Bank of Canada and the Federal Reserve of the United States lowered interest rates by 25 basis points. This is a move that was widely expected by the market, and no one really remarked in any kind of a meaningful way. Also, it should be noted that for the next two meetings, basically until the end of 2025, the Bank of Canada and the Federal Reserve have their calendars aligned so that they will be making policy announcements on the same day throughout the remainder of the year as well. That's important because we're looking at a situation now where the world is becoming more and more agreed upon in terms of what we're heading into. The economies are slowing down throughout the Western world, and central bankers are doing what they can to mitigate the harm that might be caused, especially with regard to the employment numbers, by lowering rates in anticipation of employment numbers softening. Here's the problem. Even though markets generally like the idea of rates being lowered, they're really a sign of the economy being in trouble. Think of it as an antibiotic. When interest rates are lowered, it's because the economy needs help. It needs medication to keep itself moving forward. When markets, in fact, go up, it's oftentimes because rates have come down and the stimulus of rates keeps things moving along. In other words, even though the market has been very happy with rates having come down, you as an investor and as a person who has a job and as a person who is concerned about the overall economy might be a little more worried than you otherwise would have thought. We're in a situation right now where interest rates are lower because the economy is weak. And when we have a situation like that, it oftentimes means that unemployment will rise further. And of course, as Milton Friedman says, inflation is always and everywhere a monetary phenomenon. And when rates become too low and stay too low for too long, it tends to be inflationary. When you combine these rate decisions with the tariffs that are only now starting to be felt throughout the Western world, we have a scenario where inflation could become a serious problem before the end of the year and certainly by the beginning of 2026. Stated differently, there's a reasonable chance that by the time we get to the beginning of 2026, these rate cuts that we saw in September might be seen as a policy error because inflation might start to creep to be out of control. Time will tell, but I, for one, am getting worried. This has been Weekly Wealth Update, a Make Better Wealth Decisions podcast dedicated to explaining how current events impact your portfolio and the wealth decisions you make. Tune in every Monday for commentary on how the news of the week affects your portfolio and your thinking.